Ever pondered over the difference between trading and investing? Let's delve into the basics. Trading, in a nutshell, is an approach that involves frequent buying and selling of financial instruments like stocks, commodities, or currency pairs. The ultimate goal? To generate returns that outperform traditional buy-and-hold investing. Traders are like sprinters, aiming for quick wins in a short span. On the flip side, we have investing. This is a more patient approach where you buy assets with an intent to hold them for the long term. Investors are more like marathon runners, focusing on the finish line that could be years, even decades away. They invest in assets that have the potential to increase wealth over time, not just for themselves, but potentially for their children and grandchildren. As you can see, both trading and investing involve dealing with financial instruments, but their strategies and goals are poles apart. While they might seem similar, trading and investing are quite different in a number of ways. Risk is an inevitable part of both trading and investing. It's like a dance with the unpredictable, where the music is the market's ebb and flow. Now let's talk about the risks involved in both these financial ballets. Trading is akin to a high-energy salsa. It's all about the quick steps, the frequent buying and selling of stocks, but this rapid pace comes with a cost. The potential for significant losses is higher because you're always on the dance floor, constantly exposed to market volatility. Investing, on the other hand, is more like a slow waltz. It's done with a long-term perspective, usually with a diversified portfolio. This dance allows for more graceful movements, absorbing market fluctuations over a longer time frame. The risks are more spread out, making it relatively safer than its faster-paced counterpart. So if we look at the dance floor from above, we can see that, therefore, when it comes to risk, trading is riskier than investing. The potential for returns is what attracts most people to trading and investing. The allure of making a quick buck draws many to trading. Traders thrive on volatility, taking advantage of short-term price fluctuations to earn profits. These profits can indeed be substantial, but remember, they also carry high risk. It's like a high-stakes poker game, where the stakes can be sky-high, but so can the losses. On the flip side, we have investing. The goal of investing is not to make a quick buck, but to build wealth gradually over time. Investors aim for steady returns over the long term. These returns might be lower when compared to trading, but they are more predictable and consistent. It's akin to a marathon, where the focus is not on speed but on endurance and persistence. Hence, while trading can offer high short-term returns, investing provides steady long-term returns. Time commitment is another crucial factor to consider. Let's talk about trading first. It's like a high-speed chase. You're constantly on the move, watching every twist and turn of the market. You're analyzing charts, studying trends, and making split-second decisions. It's thrilling, no doubt, but it's also incredibly time-consuming. Now let's flip the coin and look at investing. It's more like a leisurely stroll in the park. You're not concerned with the minute-by-minute fluctuations of the market. Instead, you're focusing on the broader picture, the long-term trends. You're picking companies or assets that you believe have potential to grow over years, maybe even decades. It's a strategy that requires patience, but it certainly doesn't require you to be glued to your screen all day. In the end, both paths have their merits, but they cater to different lifestyles. So, when it comes to time commitment, trading requires more than investing. There are other factors that differentiate trading from investing. Let's delve into a few more considerations that can help you decide which path to take. First off, there's the emotional toll. Trading, with its fast-paced, high-stakes environment, can be a roller coaster of emotions. The potential for rapid gains and losses can cause stress that isn't for the faint-hearted. On the other hand, investing tends to be a smoother ride. It's more like a long, scenic road trip than a white-knuckle roller coaster ride. The slower pace allows for a more measured and less emotionally charged approach. Next, we have the knowledge requirement. Trading requires a more technical understanding of the market. Chart patterns, technical indicators, and short-term market trends are the trader's bread and butter. It's like being a surgeon, needing to know the intricate details of the human body. Investing, however, is more akin to being a general practitioner. You need a solid understanding of the market's fundamentals, but the knowledge required is broader and less specialized. You're looking at the overall health and long-term prospects of a company, rather than the minute-by-minute fluctuations of its stock price. Lastly, let's talk about the capital requirement. Trading, particularly day trading, often requires a larger capital outlay. Think of it as buying a sports car. Fast, exciting, but not exactly cheap. Investing, on the other hand, can be more like buying a reliable sedan. It might not have the same thrill factor, but it's accessible to more people and can still get you where you want to go. To wrap it up, trading and investing are two different approaches to the financial market. The choice between the two depends on your risk tolerance, time commitment, and financial goals. Remember, whether you choose to be a trader or an investor, the most important thing is to make informed decisions, stay disciplined, and never stop learning. After all, the journey to financial success is a marathon, not a sprint.